I usually will give the markets a band that it can move where I ignore. I just don't care. It's not moving far enough to make a difference to me. I'm not going to even worry about it. When it gets above or below that amount of noise, like a band on top of the noise and a band on the bottom part, if it goes through the top part, then it's in an uptrend, I want to be long. If it goes through the bottom, it's short, I want to go, it's downtrend, I want to go short. So I try to not make it more complicated than that. And I think a lot of people spend a lot of time, for instance, in currencies, trying to figure out whether Brexit is going to do what to the British pound and what's the euro possible breakup going to do. And what you're doing is spending a lot of time intriguing your human brain, trying to predict things and investing your psyche in one way or the other. And then when the markets prove you wrong, you're beating yourself up for being wrong. You're a little harder to, or a little slower to pull the trigger and get out of the trade, maybe because you're married to it a little bit psychologically. Right. And what I find happening with a lot of traders is the prediction process gets them into trouble over and over again.
Hey everybody, welcome back to the Real Traders Podcast. In today's episode, we have Tom Basso. He's a hedge fund manager. He's been all over the place when it comes to the trading world. He really knows his stuff. He and Nick have a great conversation, so sit back, relax, and enjoy this episode.
Hey everybody, welcome back to another podcast episode. Today I am with a very special guest, Mr. Tom Basso. He is a well-established trader in the world of traders here, and I have the pleasure today of asking him some questions. He has some experience in the hedge fund world with his company TrendStat, which was around for back in, what was it, 2000? Early?
I closed it down in 2003.
Okay. Yep. So he had his own hedge fund for a while. He's been trading. I know that you've traded a long list of assets. You've traded commodities and Forex, and I believe nowadays you're even dabbling with cryptos. And before we were jumping into this, he was talking about trading the Russell. So he's trading all sorts of things and still doing it all. So Tom, how are you? And welcome to the show.
I'm doing great, Nick. And if it moves, you trade it. You know,
that's a good
way. I think right
it.
now I got something like 60 positions across 9 strategies.
That's amazing. That, you know, and it's like you've been doing this for obviously for a lot longer than I have, and here you are, you're still running that many strategies, you're still this active in it, and you're in retirement as well. So this is clearly something that you absolutely love.
Yeah, I mean, I'm just managing my own portfolios. I got 4 between my wife and myself, and so it's not hard duty, really. I was sitting here. The only reason I did a trade before we went on was it's set up. I was working on a new book that I'm writing that'll hopefully be out by year end. And so while I'm stuck at the desk, I can go ahead and, you know, every 5 minutes or so look over and move stops. It's no big deal. It's not hard. It's not hard duty being me.
That's fantastic. Well, that's amazing. Hopefully I can be in your shoes someday. But until then, I'll ask you a few questions that may help myself and some of our viewers.
Sure.
Tom, how did you get started in the world of financial markets? A little bit of your backstory. I've heard it, but for people who don't know already.
I started out as a paper boy at 12, which an interviewer the other day said that's what Warren Buffett did when he started too. I didn't know that until like yesterday. And but in any case, what ended up happening was I had this extra money piling up. I knew college loomed in 4 years, or no, 12 would be 6 years. And I knew my dad was a postman. I knew he was going to have a huge amount of money to pay for college education. So not wanting to take on a lot of debt, I started saving my extra little $10 a week or so, and I stuck it in a mutual fund, stock mutual fund. So I was investing when I was 12, and got out of that when I came out of college, and it had gotten back to break even roughly at that point after the 73, 74, 50 cents on a dollar bear market, which taught me a lot about risk and what can happen to mutual funds when the stock market decides to go down by that much. And so I started looking as a chemical engineer at various chemical companies, got a job. The recession, you haven't seen it at your age probably as much, but back in the 70s and 60s, there was a lot of booms and busts. And engineers would be hired and then engineers would be let go and you'd be laid off. So I thought, I better have some rainy day money put away. And I started saving some money, and the guys around the lunch table were all engineers, and they all had the same situation, and they had portfolios, and we started talking about stocks, and it became sort of this one table that constantly talked about investing. And one thing led to another. I started charting, a point and figure back in those days. This is pre-personal computer.
Right.
This is add, subtract, multiply, divide calculators in pieces of paper and chart paper. That's how far I go back. And PCs came around in 1980, and I started programming some of the simple stuff I was doing. One thing led to another. I got an IBM AT. Computers kept getting more powerful. I actually hired a programmer to help speed the process of various developments. I got into futures before the PCs came in, and took about 4 years to get to break even. So that was an interesting time in that I was losing less every year, and that was progress. It took some, I don't know, discipline and stick-to-itness, I guess, to keep on trucking, but I did. And once I got into profitability, I stayed in profitability. And so now I had a stock portfolio doing real well, a futures portfolio doing real well. I'm starting to manage other people's money a little bit. I sell my shares in the original three-partnered investment advisory firm and formed Trendstat Capital. And that was the firm I shut down in 2003. At its peak, I think we managed $600 million roughly, and probably best known for our currency stuff at the end, because that was the bulk of the 600 million.
Sure. And that's probably a great talking point for my audience. We specifically talk a lot about currency pairs and trading actively in the foreign exchange market. I wanted to ask, before we jump specifically to currencies though, what made you, and I've always wondered this throughout your interviews, you have traded such a diverse list. A lot of people, they'll find their one spot and they'll kind of stay in one zone. They'll trade stocks or equities, or they'll trade specifically cryptos. What made you, and you had kind of talked about it earlier where you said anything that moves I can trade. Why specifically have you had such a diverse list of assets that you actually trade actively?
I sort of liken trading and doing the indicators and things to chemical engineering days, back when I use the example a lot, where you've got a stream of chemicals going through a pipe, and you want to hold it at a certain temperature to, input it into a reactor of some sort or whatever. So you have a temperature control loop that'll go on. You'll have a thermometer in there and it'll measure the temperature. And then the outside temperature, maybe it's in wintertime, maybe it's going into nighttime, but the temperature of the pipe is starting to get ambient cooling going on. So the chemicals are losing a little of their temperature. So what ends up happening is a temperature control loop says, hey, I need more steam to the exchanger to heat this thing up. So it opens a valve, steam comes in. Now we're back on track, and we feed the reactor with the proper chemicals at the proper temperature. Well, the market I look at is similar and I'm talking all markets. There is noise and information. And as a trader, I always feel my job is to extract the information out of the noise. And there's a ton of noise. If you sit there and look at a typical 5-minute bar, or even worse, a 1-minute bar, you'll see all sorts of stuff going on that doesn't really, when you step back and you stick a chart on the wall across the room from you and look at it, you'll realize that there's maybe one move on that entire chart that you really wanted to catch. That was the bulk of the profit for the day. The rest of the stuff was nothing. It was not going to make you money. It might lose you money, in that it's just noise. And so when I look at things like the latest thing I've gotten into is cryptos, it's the same to me. Cryptos go all over the place. There's lots of noise, but there's movement. And again, if you put the crypto chart against the wall or, way away from you, you can see the moves you want to pick up. If you pull it up close to you and you look at all the little nonsense, you're just looking at a lot of noise. So what all the indicators I try to use always try to separate information from noise. So I usually will give the markets a band that it can move where I ignore. I just don't care. It's not moving far enough to make a difference to me. I'm not going to even worry about it. When it gets above or below that amount of noise, like a band on top of the noise and a band on the bottom part, if it goes through the top part, then it's in an uptrend, I want to be long. If it goes through the bottom, it's short, I want to go, it's downtrend, I want to go short. So I try to not make it more complicated than that. And I think a lot of people spend a lot of time, for instance, in currencies, trying to figure out whether Brexit is going to do what to the British pound and what's the euro possible breakup going to do. And what you're doing is spending a lot of time intriguing your human brain, trying to predict things and investing your psyche in one way or the other. And then when the markets prove you wrong, you're beating yourself up for being wrong. You're a little harder to, or a little slower to pull the trigger and get out of the trade, maybe because you're married to it a little bit psychologically. Right. And what I find happening with a lot of traders is the prediction process gets them into trouble over and over again. I would rather just measure the prices, see what they're doing. When they go to an uptrend, I buy. When it goes to a downtrend, I sell. I don't think a lot about it. This recent upswing in the stock market, I mean, as an amateur behavioral economist that I am over my whole life, I'd like to think I know quite a bit about economics, having been in the business of this and had to deal with economics and economic questions the last 50 years, roughly. I have to say, this up move that's happened, I just was tweeting this morning, I'm astonished that 9 of my 20 positions are now in profit. And my hedge that I took off is now got a stop sell above where I took it off. So I'm ahead on that too. Yep. So this up move has had some legs and seems to be just carrying on. But I look at the economy and I see all sorts of red lights. Housing prices starting to slip, interest rates going up, recession definitely is in place with 2 down GDPs. It's not great news going forward, but the stock market's shrugging it all off and going to new highs if it wants to. So I'm just going with it. I don't question it. I don't sit here and cerebrally try to figure it out. I just say the market's strong, I go.
Yeah, that's fascinating. And just a simple, I like the way that you talked about just that simple concept of, to filter out noise, you're just looking for something that is essentially breaking what would be an expected move of the day, something like that, and looking to go with the flow. And then I assume, just because I've heard a lot from you before, that even if you have an idea, and I think this is possibly another area where a lot of people struggle, is they have an idea, but they sell it to themselves like it can't possibly go wrong, and they put on a very large position size. I can probably assume that you do the exact opposite because you're very not predictive with what you're telling us here.
Yeah, I don't sell myself any ideas. Yeah. When you're trading 9 different strategies, you just try to keep up with it and you don't think a lot. And so that's one aspect of it. The second aspect of it is position sizing. With every study that I've ever done on it, in the book I wrote on it, that it's sold thousands and thousands of copies now at $10 a book. It's hardly too expensive for anybody to be able to afford. Right. Every study I've ever done shows that position sizing is more important than your buy-sell engine. And the buy-sell engine, by engine, I mean an engine motivates you to do something. So it's the type of thing where an engine motivates the car to go. So the buy-sell engine motivates the trader to do something, it buy or sell. And everybody spends their time, I talk about Keltners, I talk about Dunshans, I talk about Bollingers or something. They all have that same sort of volatility adjusted range type trading that fits my personality. It doesn't fit everybody's. I'm not recommending that everybody go out there and do those 3 indicators. Right. It just fits me. And the parameters I use fit me. They fit my situation, my capital, my time, the amount of trades I want to do per year, the types of markets I trade. It fits me. If everybody tried to do the same thing to their own portfolio, they'd be way ahead of the game. And so I think that when you're really trying to sell yourself on something, and you've got the story all down. You could tell it at a cocktail party just like that. You're investing yourself in that thing, and that's not good trading. That's setting yourself up for psychological challenges, and you certainly are going to have a hard time being serene about your trading when it goes against you sooner or later on one of those ideas that you sold yourself, and you find yourself having to make a tough decision and realize that, gosh, I knew that was 100% going to work, and it didn't. And I've had plenty of those back in my earlier years, and I quickly learned, thankfully, to not trust my own opinions of the way the world should work, and instead focus on what is happening now and positioning my portfolio each day, each moment for right now. What am I doing right now? I don't care what's happening tomorrow. I just want right now.
That's fantastic. And I think one more thing just to prompt you as well on is, I know that you are a tried and true trend follower, because with what I've heard from your experience, or at least with one of your strategies, I'm not sure with all of yours,
quite a few.
Quite a few.
It depends on whether you're talking long-term or short-term. I've become a short-term trend follower as well. A lot of people might think that's more mean reversion or overbought, oversold trading, but to me, it's still trend following. It's just very, very short-term.
Sure. Well, so regardless, I know that a lot of with what we've talked about so far is small position sizing and never overestimating one single trade, but rather just waiting for the noise to break, looking for something that you can jump in long or short and ride for as much as you possibly can. Sometimes people, in my experience working with traders and on YouTube and stuff, I use a very strict, probably in similar ways, trailing stop method. And the reason that I do that is similar to you. I don't believe that I can really call a perfect entry or a perfect exit in the market. So all I can do is I can fix my risk with a stop loss, and I can trail it to potentially have an unlimited profit on, perhaps you could call it a lucky trade or just a really amazing move. For me, I've had Tesla has done that to me. That was one of my best trades ever, where I was able to just kind of trail a stop loss on it for a long period of time. I know from one of your past interviews, I believe, that during your days with Trendstat, you had a couple trades that were phenomenal, and that you even in your conversations spoke, I didn't really know they would do all that. Can you think of any trades off the top of your head that were like that?
Well, just recently, Bitcoin going from 60 or 70 or 80 or whatever it was, all the way down in the low 20s or 19. I shorted the futures, ended up with a huge profit. I had no idea. I don't know. I barely understand I understand the concept of cryptocurrencies, and I'm kind of intrigued by having another currency besides a fiat currency, which I don't think the Treasury and the Federal Reserve is doing a great job managing, frankly. And so having an alternative and seeing it move around, it becomes a nice trading vehicle. But I can't think of any fundamentals that are involved. I liken it to sort of gold. Gold trades at the price that people want to trade it at. It has no particular, you can't eat gold. It doesn't have a true industrial purpose at the price that it is. It might have an industrial purpose, but it has to fight off other metals to do it. It just seems to me that fundamentally, you have no idea whether it's going to go to 20 or turn around and go to 200,000. Right. I just don't know. But the trend ended up down. I went short.
And there it goes.
And I'll tell an Ed Sequoia story. I was attending a THARP conference. Actually, Van Tharp was holding a peak performance seminar, and Ed Sequoia was the model trader that week. And I took over for him after he didn't do it anymore. And he had a question from the audience. Said, "Now, when you get a trade going over, what would be your objective?" And he looked for a second and he said, "Well, my objective would be for it to go to the moon. I've never had one happen, go that far yet, but I keep hoping."
Right.
And that's the answer. He doesn't know. He doesn't have an objective.
Right.
It's just like you said, keep moving the stops up. Sooner or later you're out, and whatever it is, it is.
Yep. Yep. That's fantastic. And
it sounds simple, doesn't it?
Almost too simple.
Why do people make trading so complicated? I don't know.
Well, to me, I think of it just in a simple form. It's hard enough getting the entry, right? The entry by itself, for a lot of people who focus, like you said, with the engine, people focus so heavily on that. I think you double your efforts if you try and call exactly when to get out of the trade when it's gone in your favor. I mean, I suppose with a stop loss, you're just saying this is how much I'm willing to risk on this idea, and then let it go. And sometimes you're surprised by a move. Another one for me, and I listened to a recent interview from you with a yen trade that you had. I also had a yen trade the past year or so. The yen has been absolutely incredibly weak, and a lot of the pairs have moved against it. It's amazing how those trades, they don't come very often, but when they do, they can be absolutely game changer. And it's less about prediction and more purely just managing your risk and letting a trade run like that.
Yeah, that yen trade was very, very profitable. I got that one too. I mean, I trade so many different markets. If anything makes a move, chances are I've participated in it somehow.
Right.
And the negative is, of course, I'm participating in all the other markets that don't go anywhere, and they're just whipsawing me, and I'm managing my risk, managing my position sizes, and that gets paid for by that big winner, the big yen trade or the big Bitcoin trade or whatever.
Sure.
And when you add it all up, you 60 different positions and 9 different strategies, you know, if it comes out with a green number at the end of the day, you just kind of
right.
Okay, it's another day. Let's keep going. You know?
I have a follow-up question on that too.
Sure.
With a way of managing a position, let's say that you have a trade and it's running in your favor, and you're happy to continue holding it. Do you ever actually add to a position that's going well, or do you purely just let what you have on run as far as you can and then reset when it's done?
All right, so let's get into 2 different topics there. One is that when markets start running a long distance, you saw that in the Japanese yen trade to a certain extent. Mm-hmm. Panic or enthusiasm, whichever way it's going, sets in, and you get usually increased volatility later in a trend than the boring time that you had when you started the trend. So what you'll find happening is, you know, nobody cares about the market. It breaks out, you know, Tom gets in, and a few fundamentalists have already gotten in because that's what pushed it to the breakout. And now that it's out, you get maybe a pullback, and some of the pullback traders will jump in, and then it starts swinging and it's making the news, and then you get bigger and bigger swings, and the ATR, or average true range, starts increasing. You start seeing larger bars on the chart, or candlesticks if you use candlesticks. And what will happen is the risk frequently will increase and the volatility will increase as you go into a mature trade, and everybody knows about it, and everybody is either kicking themselves for missing it or jumping on late. So I always try to hold my risk and volatility levels to a specific preset, predetermined level. When markets get too high in their risk as a percent of my portfolio equity, or if volatility of that position gets too high as a percent of my equity, I just peel off whatever I have to peel off to get back down into an acceptable range.
Okay.
So that's the opposite of what you were talking about, adding on. But that's what I'm doing. I'm peeling off. Okay, now let's talk about the adding on. I did a study back at Trendstat days, and it took a while to get this done, and it was a whole lot of data and databases involved. But we took 20 different markets, and we ran a normal, one of our standard Trendstat trend following models that gives you buys and sells. We bought into that, and then we applied our actually, in that case, we did not apply any position sizing except for the initial position sizing. And then what we did is we tracked day 0 was the day we got into the trade. So either long or short made no difference. That was day 0. Day one would be the next day. Day two would be the third day, and so on. And we tracked every trade to completion, which would be day X, and it would vary all over the place. Then what we did was we set up the return to risk. We know where the end point is of every trade, and we know where we are right now. So we have 100% foresight on what is going to happen. We don't know that as we're trading, but this is an analysis of the actual trades. And it turns out very clearly the return to risk of a trend following model is the highest on the day and at the moment of the initial transaction. It deteriorates, and logically you can think about this. If a trend is going and maturing in your favor, sooner or later, it's going to hit your stop. So you're a lot closer to getting stopped out the farther the trade goes into the trade, and your return to risk ratios start getting worse and worse.
I see.
And so eventually, I mean, you can get situations where, yeah, okay, so you've had a nice run, you've had a nice pullback, risk is mitigated as a percent of equity, but you still have the potential smaller return to the end of the final trade, and you still have a risk involved with that trade of losing. So the return to risk start deteriorating right after you get into it, it turns out, on average, I say.
Interesting.
There's lots of exceptions. So therefore I don't add.
Gotcha. Okay. So with that said, if you kind of had an idea based on those 20 assets that you tested, if you had a rough idea of when that trade would sort of mature completely on average, would you ever close a trade preemptively in that case, or would you still just trail stops for that potential extra profit that's there at the end?
No, in trend following, you're going for that long tail. You want to get that tail that ends up being the Japanese yen position you're in for 15 months or whatever, and you make just a ton of money on it. And you don't know ever where the end of that is. And so I don't cut a trade off. Now, if I'm short-term trading, like I'm intraday, you know that the end of the day is an obvious point at which you need to be out of the position. So what I'll do there a lot of times is my initial position will be, say, 3 or 4 or 5x. So X would be the minimum size that I can hold in the trade, and I might trade 3 times that amount, let's say. Now I'll set up a 1R. In other words, I'll look at my stop loss. I'll look at the risk I'm taking on in the trade, and at that same amount of movement in my favor, I'll peel off 2/3 of the position and then let the other third run. What do I got there? Then I've got a 0 risk trade. I've already broken even on the trade. No matter what that last 1/3 does, I'm already done. Now it's just a matter of how much I'm going to make.
Very, very
cool. Because of the nature of day trading, I'll do those types of strange things. And that's the closest thing I can think of to me actually putting a limit order in. I hardly ever use limit orders. I don't really use them on any of my long-term trend following. I can't think of a single instance where I'd ever put a limit order in.
Sure. Makes sense. If you don't need them, you don't need them. I don't use them either. I usually just execute a position when I need to with market order, and if it's there, I let it run. If it's not, I cut it short. But I wanted to ask also, if you could take us a little bit. Very few of the people probably watching this have ever experienced anything in the world of hedge funds and your world of TrendStat. Can you just tell us a little bit of what a day-to-day world that was for you? Like, what were you doing on a daily basis running the firm?
Well, you got 10 employees at the peak, so you've got who wants to be here and work during Thanksgiving or maybe on 4th of July? Because guess what? In London, they still trade currencies on the 4th of July. We protested and revolted against them. They're still open. So there's people don't think that through. The stock markets in the U.S. are closed, but the rest of the world sometimes ignores our holiday.
Right.
I don't think they care about Martin Luther King Day either. So you've got lots of holidays, lots of situations that you're trying to manage. People trying to, well, they're ill at times. They have to take a sick day or they have to go help their kids get out of school because they're sick or whatever. There are all sorts of things that happen. So you have to really sit and think through what is it that you're doing as a money manager. In my mind, and it's different than a lot of other hedge fund guys, my job is to manage people's money to the best of my ability, the way that they would feel comfortable with me managing it. I'm not managing my money and allowing them to go along for the ride. I'm managing their money. And that's a really big difference. And so you got to have backups. If you have a head trader or a first string trader, you got to have a backup trader. If you have a programmer that can get into and run all the operating systems that your company's running on and the internet and everything else, you need a second person that understands how to do that. Because if the first person's not there and the internet goes down, what's our backup plan?
Yep.
And so there's just a lot of contingency planning, a lot of dealing with client inquiries, marketing trips, because I'm the name guy at the firm, thanks to New Market Wizards primarily too. Everybody wants me to give the talk or give the presentation or meet the client and shake hands. So, it got to where at the end I was probably gone, I don't know, pushing a half of the month.
Wow.
During a normal month, like Christmas and December, you could stay at home pretty much. Nobody wanted to meet you, but starting around January 15th, it would just perk right up again and away we'd be on the plane. And I got really tired of traveling. When I shut the whole thing down in 2003, I put a smile on my face and it's not gone away since.
Yep.
And it's hedge fund business, especially now with backups, and you have to have a staff of, compliance officers and all these different things. I tell you what, it's a tough business. I don't regret shutting it down and being retired. It's so much more fun managing my own money. I don't have the laws and the audits, the SEC coming in and the state of Arizona and the National Futures Association, and these kids 6 months out of college would come in and try to start going through my files, and they'd be asking me questions that clearly told me they had no clue what they were talking about. Yeah. So then I'm faced with teaching them the question that they're supposed to be asking me instead, and why, and then answering the question that I just posed.
My goodness.
It's just a big waste of time.
It really does sound like such a headache to run a firm like that. But I'm sure that, there was a million experiences that you learned from doing that, a lot of which very few of us will ever get to experience. I mean, I don't envy personally managing other people's money, just because I think I'd be very nervous about it. It's like you said, managing your own money, there's nobody going through your books or going through anything like that. And you can trade how you'd like to trade. And that's kind of that's definitely a positive for sure.
Yeah, it sure is. And the clients do add another level of stress, because you find as a money manager, I've said this, a few times, I don't know if people in money management industry really appreciate it, but you can only be as good a hedge fund manager as your clients will allow you to be, because they have the ultimate power of pulling the money.
Yep. If
you're doing something that is brilliant and you understand it and it's a great return to risk, but it's got, a drawdown of 20% or something built into the thing, the 20% comes along, half of your business leaves, and you're sitting there, wondering what happened. I'm doing exactly what I told him I'd be doing. I showed him the track record. The track record had a 20% drawdown in the past, and now I've suffered another 20%. And I'm probably going to make new highs again, and half of your business is gone.
Yep. Right. Exactly.
And so you find yourself having to deal with client psychology, and you'll also find that the money management clients out there, I hate to say it, are not that really good at investing, which is probably why they tried to hire you.
Right.
But they didn't leave behind their biases as a bad investor when they came and gave you the money. They didn't say, okay, I'm truly going to let you do it and turn my brain off because I don't know what I'm doing, and you do.
Right.
They continue to meddle. They continue to ask. I had people ask me the same dumb question every year after year. I answered it exactly the same way. And a year from now, if they're still my client, I know they're going to ask me the same question all over again.
It's fascinating how that works. I think a lot of it is similar to people like always, of course, they want someone or something to blame. It's always an external factor that's causing some sort of trouble. Whereas if you are the trader or the investor or the manager of something, you understand how it works. You understand that there is no free lunch in the markets. There is no chance to just have positive returns month over month without any sort of struggle ever. That's not, you're in the wrong business if you don't want to deal with some of the trouble that comes along with it. So
absolutely true.
Yeah, and then dealing with, of course, just people's commentary. It's similar to oftentimes people will ask, can I just copy somebody's trades? And they bring, like you say, the same psychology of what failed them. They can't copy you properly, even if they wanted to, because as soon as things start going sour, they don't understand that, within an equity curve, there's downturns and there's swings back to all-time highs. And that's how a trading strategy works over time. So it is fascinating, the human psychology of that. So I can imagine that when you shut it down and you were with your own funds again and in the privacy of your own trading and you understand how it all works, that was probably a nice wave of relief, I can imagine.
Well, and the other thing is, you and I are both traders. There's no way that I have no idea what you do, and you know a little bit about what I do just because I'm more of a public figure, perhaps. I don't know.
Right.
And you've listened to some of my interviews, but the reality of it is my life and your life, the capital that I trade, the capital that you trade, the computer skills that I have, the computer skills that you have, math skills may be different, temperaments may be different, seasoning, risk tolerance. You and I are different. It's a different situation for both of us. Why in the world would anybody think that you and I should trade precisely the same? Exactly. It doesn't make any sense logically when you think it through.
Right.
I don't have the time. You may trade all day long, eyes on the screen, whatever. If I can get away from this office, I'm out of here. I'm going to go hit golf balls, go work out, go for a hike, cook dinner or cook lunch, whatever. I'm going to try to do something different.
Right.
I don't even get into the office till usually about an hour and a half after the market opens in the morning. And some people are real big on, you got to be there for the open. Well, it's 6:30. I'm retired. I don't want.
Right.
I might be getting up at 6:30. By 8 o'clock, I'm having my second cup of decaf.
Right. Exactly.
I'm not rushing through my morning just to try to meet the open of the market. So I have to design what I do for who I am, my risk tolerance, my capital, my computer skills, my time that I'm willing to put into the research, and the time I'm willing to expend each day to manage the money. And that is going to be completely different than every other person out there, because I'm unique and you're unique. And so is trader, that's listening to this thing. And but people continue wanting to know, why do you use the 21 day on your Keltner bands? Well, because it fit what I needed.
Right.
You might want to use 18 or 15 or whatever. It's not magic.
Right. Well, and Tom, that actually makes me think of something else too. So you mentioned with each person, there is a different style, a different account size. There's a different what time of day you can be trading. Like everything can be different person to person. What would you say to somebody who's listening to this, who is early on in their career with trying to get involved with markets? How would you find that style? What's the best way to find your style of trading or your approach, something that works for you? Because you often hear that trade what works for you, but how do you find that? And how would you tell somebody how to approach that?
For me, it was taking some charts, and you could, now today's world, you could just print out screens from all these fancy computers we have. If you can just get a printer and do it in color or whatever you have to do. And I just sat back and I tried to look at charts, and I just tried to see, is there any common things that I notice? Like the thing I noticed when I sat and I put, say, 10 or 20 different charts of various commodities, agricultural, currencies, whatever, all across the floor. And I was sitting on the sofa just looking down on the floor. And so these things were pretty far away from my vision. I'm in my long distance vision at this point. And you can kind of say, that corn trade right over there, boy, wouldn't it have been nice to get that one. and so on and so forth. And that led me back to then circling those big trades and then putting them on more of a kitchen table and trying to see, well, what was happening just before that happened and what happened over here just before that happened. And I started seeing commonalities, and then that gave me an idea of some kind of a logic that I could use to trigger a trade. And the other thing you can do is an Investopedia. It's INVEST and then O and then pedia, like encyclopedia.com. It does a great job, I think, of giving you the formulas and the descriptions and how typically the indicator is used. I would go to Investopedia, it's free, and just start at the top and just go through and try to understand some of the indicators. If your broker platform that you're using for your trading has some of these indicators already live, pull them up against some prices that you, in markets that you want to follow, and see what they look like and see how, well, where is the point where the prices cross that line or trigger a trade? What can I do with it? Does that make any sense? I understand the math. I don't feel comfortable with that math. So you move on to the next one. And then for me, when I got to something like Keltner's, for instance, that just fit me to a glove. I just said, that's perfect. I've got an exponential moving average. I can set that at whatever time I want. I chose 21 typically. It's got a top and bottom based on the volatility, ATR times a factor. I usually use 2.3. And there's a reason for that, but it's not important. You can use whatever number you want. 3 would be wider bands. 2 would be shorter, tighter bands, whatever you want, whatever works for you. Custom design it so you can say, I understand the math and the logic. I know when I'm going to make money. I know when I'm going to get whipsawed. I've designed this thing, my strategy, for up markets, down markets, and sideways markets, and I understand completely what's going to happen in each of those scenarios.
Right.
Now you're starting to get ready to go and trade. You've got a buy-sell engine. You understand it completely. You understand when it's going to have a good day. You understand when it's going to have a bad day. You understand when it's going to sit there and do nothing. And now you're starting to get the mental process in place to be able to take on putting on your first trade.
I like that a lot. And I think, one thing that I sort of respond to that question too is because it's a very common question. I've been on YouTube for a while, and a lot of the people that their first question is, Nick, what kind of trading strategy out of the box can I start using? And that, that's the golden question. I wish I could have, out of the box golden ticket question. But I think what you sort of explained is basically developing a genuine passion for this stuff. Because you just said, go to Investopedia, go to the basic dictionary for this stuff, and just start reading and start digging through and finding something that connects with you, and then keep going down those different avenues until you land on something where you're like, okay, I'm starting to actually understand this. It's within my understanding. I can find something that I can reasonably start to test and start to work with. But I don't think I've ever met, and I've had the pleasure of speaking with a lot of fantastic traders. I don't think I've ever met somebody who's not incredibly passionate about this stuff, who's actually been successful. Everybody wants this thing to be this sort of, very quick roll it out on a mat and just start making money from it. But it is absolutely not the case. And I think one other trap is a lot of times it's kind of like I went to a casino with some friends. I had a bachelor party actually this past week, and we went to the casino, and I found myself thinking how similar when you walk through and you see all the slots machines. It's so very easy for us as human beings to see those and start making up patterns in our head and thinking that we can predict something. But if you actually do the math and you actually study casino games, almost all of them are unbeatable, except for perhaps like blackjack, but that is mathematically it's a very difficult thing to get good at. Regardless, similar to market,
and then you get banned from the casino.
And then you get banned, right. So even if you do beat it, you get walked off the table. Regardless, the interesting thing there is that it's very easy to jump to a conclusion, but if you take the time to go study something and dig deep, you'll find that a lot of it is smoke and mirrors. And nothing is as easy as it seems. So you're going to get all these people on social media that, blow up these golden ticket ideas and the Facebook ads that run all over your feed and stuff that tell you how easy trading is. It's almost laughable, especially when we get someone like you on here who has years of experience, who's been doing this for a long time. And here you are telling us that, some of your best trades are purely trades where you take a position, you manage a risk, and it does way more than you ever expected. And after it's all, people doing the opposite.
After it's all over, I can frequently tell you why it was such a great trade, but at the time of the trade, I had no clue.
Right. That's fantastic. Yeah. No. And I think that's something that a lot of people, I think, need to hear. And nowadays, a lot of the social media marketing has gotten incredibly good at selling people on that idea. And I know everyone hears, of course, the Lamborghinis and stuff like that. But more so now, people are coming up with just these sort of fancy named strategies and, option strategies and this and that, and how amazing it's going to be and how you can, make 15% a month and all this and that. What would you say to someone who is looking to, let's say that they're finding their style and they're looking for return on investment as a trader? I know it's a tough question to answer because it also depends heavily on how much money you have, how much you're willing to risk, etc. But what would you say an average trader could consider looking at month to month on average over the long term for returns?
Well, month to month, and this is what clients do a lot. They take your 15% per year return that you've done over the last 10 years of your career, and they break that back down into monthly returns, and they expect you to, nail that.
Right.
And of course, some months are down, and they're also, worried all of a sudden. So I would say that month to month is not even worth worrying about. I'd say per year, I think something along the lines of, say, twice long-term interest rates would be probably something I'd tend to shoot for, which would probably these days would put you in the teens someplace, low teens.
Yep.
I'd be totally delighted with low teens year over year on a rolling year basis. I don't worry too much about any one month because I have good months and bad months. But I mean, just doing the same things I'm doing right today, back in 2020, I ended up with 103% year.
That's
best of my entire life.
Oh my goodness.
It was not leveraging. It was not doing some kind of, let's put more money in palladium because I really think palladium is going to go up or something. The COVID crash forced a lot of stuff into violent, huge moves.
Yep.
And so across the board, I am green, shorting everything in sight. And then it turns around. And then if you watch Twitter around probably would have been April, June, the market started finding a bottom. And what did everybody say? Oh, it's got to test the bottom. The bottom's not in yet. COVID's still creating this massive bad economy. The mandates are coming in. Airlines are shutting down and they're losing tons of money. This is going to be bad. So people were not ready to jump in. I'm just looking at my dumb indicators and the price movements are moving up and it goes through the top of the range and I buy into all that stuff.
Yep.
And then you get the post-COVID crash rally that goes crazy. Now I'm long everything and it's all green up and down my screen.
Yep.
And that's how you get to 100%.
That's fantastic.
I didn't take any different risk levels or trade any different markets or anything. I'm doing the same thing today as I was doing back then. It's just the nature of the markets fed me a lot of profits.
Yep.
It's not that I was any smarter than anybody else.
Yep. And that's a key ticket there is, as trend followers, myself included, I'm actually really honored to have heard that a lot of the same trades that I was in, you were in too, because it's like, okay, trend followers tend to land in the same spot.
Well, if you look at the CTA industry, a lot of them are trend followers, and you look at their returns. And I've done this because I was part of that industry way back when, and the vast majority of the very large traders are trend followers some way or another, and they're all in the same markets. There's only a finite number of them, so. When you have a really good month for a bunch of different large traders, the CTA indexes will have a good month, not surprisingly. And it's usually based on the fact that a lot of markets trended that month. And it's really simple.
And I also caught in 2020, to attest to what you were saying there a little bit with, that the post-pandemic, it made, to me, it was the same thing. I started buying stuff purely because the indications that I use, which are probably very simple filters as well to yours, just the idea of, okay, well, this market, yes, it's a pandemic. Yes, everything in my gut is telling me do not buy this thing. It's terrifying. I still bought stuff without leverage, didn't even need it. And I think my account, I told you I bought Tesla. So to be fair, it was the one trade that really, I bought Apple and Google and the indices and, pretty spread it out across all these different things. But Tesla was the front runner. And it was amazing how you mentioned you have 100% year. And that sounds ridiculous to somebody. But when you actually look at what those sorts of market conditions can do for trend followers, it's absolutely incredible, because it's not that we're doing anything special. It's that you're showing up, you're taking your trades, and the market is being very, it's like the wind in your sail kind of thing.
Yeah, exactly. When the wind gets behind you, you put up the jib and you put the sail sideways and you just fly.
Right.
And that's what, and that's what happened in 2020. I may not see another year like that in the rest of my life.
Yep.
I just turned 70, so my rest of my life is probably shorter than the life so far. But you look at markets and what they're doing, some of the stuff that's been moving with the Ukraine war and now we're going into this recession thing. And so you got all sorts of markets doing crazy things. And the more the Fed manipulates the money, the more you get into these strange decisions that end up having serious economic consequences, the more you sort of rattle the markets and they move farther. And that just feeds profits for people like me. I just go with it and enjoy the ride.
That's fantastic. And I think we have to ask you about your enjoy the ride phrase. I've heard it a few times. You always talk about it in your interviews. I think it's really cool.
There's a story. There's a story behind that.
Let us know what's that about.
I had a stepson and a brother-in-law that wanted to know whether I was going to be hedged or not, because they had their own portfolios and they just helping them basically. And I felt like, writing them every day an email and telling them where I am didn't make sense to me. Telling them when I was going to put a hedge on or not didn't make a lot of sense to me, because then they might not read their emails or whatever. I ended up realizing that both of them were on Facebook at the time quite a bit. So I just started putting it on Facebook.
Yep.
Well, some of my friends from the industry, as I retired, kept in touch with me on Facebook. So they started seeing that I was putting out what I was doing a little bit with my stock hedges. And they said, they're encouraging me and, they're liking it. They're making comments. Yeah, I'm getting the same way. I'm getting signals, whatever. And then one guy who was a real good trader these days, I'd say he's matured quite a bit over the last 10 years. He says, a lot of people are over on Twitter. Not very many people are on Facebook. You ought to be on Twitter. Yeah. I said, I hate Twitter. 88 characters. I hate that. I guess I'm long-winded, but that's not enough characters for me.
Sure.
And so, but I did. I compressed it down. I kept it simple. And I had just gone through a hedge trade where I put the hedge on, the market fell. And initially I was looking good. And then typical trend follower with, maybe 2/3 of your trade are losers. The market comes right back, roars back, and ends up going through my stop. I take the hedge off and I'm way ahead on my long positions that day because it was such a powerful up day. And so I kind of I said, I've taken the hedges off. The direction's now up. My long positions are slaying it today. Enjoy the ride. And the response I got from ending that one post with enjoy the ride, people were writing back saying, enjoy the ride. That's cool. That's just exactly what you got to do in trading or whatever. Yeah. And all right, well, I'll try it again. So, a week later or something, I ended up with a similar type of thing. And, the fact that markets go up, markets go down, like these positions are doing well and those are going down, enjoy the ride.
Yep.
Got more response. And so little by little, things got sort of out of hand with enjoy the ride. And I'm out golfing one day and I put a post in before I go out and golf. So I'm gone for 4 hours from the office. And I put it on Twitter and I end it with ETR. And so some new follower asks the Twitterverse, what is ETR? And some other follower says, enjoy the ride, dummy. And it is that point when that happened, I knew that enjoy the ride is going to be tagged to my back and tattooed on me for the rest of my life. So I just use it all the time now. And now, I mean, I've got 45,000 Twitter followers, and I can't tell you how every day I see ETR or enjoy the ride on the end of people's messages. Or they'll say, as Tom Basso says, enjoy the ride.
That's amazing.
So I'm getting quoted. It's clearly something that has ended up sticking.
Yeah, that's awesome.
So when I did my retirement website, which is on your screen, enjoytheride.world, it has all sorts of information on trading and how I hedge and recommended reading and videos and just a ton of junk there.
Is your
all
new
the research papers I've ever done, all the things that I've done over my lifetime. It's sort of my retirement website. I called it enjoytheride.world. .com was taken. And I thought, well, geez, I've got followers in India and Japan and all sorts of other places. It's really world.
Yeah.
So why don't we use world? So it's .world.
That's great. That's great. So before we close, Tom, I also want to ask your book that you're working on that you mentioned previously a little bit. Can you tell us just a little bit, just briefly about what it's going to be about and roughly an expected date on that one?
Expected date is by year end. I'm shooting for. We'll see if I can get it.
Okay.
There's a lot to doing this particular book because it is, it's a combination of a story of my trading life and what I learned along the way, the lessons I learned and what I did with those lessons. And the title is going to be The All-Weather Trader. And it's speaking about me basically, because I feel like I'm sort of an all-weather trader. I'm trading lots of strategies and lots of diversification and all those different tricks that I used to make it through these last 2 years or 3 years of extreme volatility, where a lot of people were stressing and straining and getting wiped out and everything else. I just kind of cruised through it all. And I think that's compelling to a lot of readers and a lot of traders who'd like to know sort of how I did that. So this book is an attempt to try to articulate to traders out there all the different aspects, the little pieces of the puzzle that I had to put together over some 50 years of trading that got me to where I am today, an all-weather trader. And it gets into the mental side, it gets into the position sizing, it gets into various forms of buy-sell engines and what they're trying to do and their good points and bad points. It gets into some of the philosophy of what people try to do with investments. It tells you a little bit about some of the pitfalls that you'll probably fall into if you're not careful when you're trying to implement your own all-weather strategy. So it's going to be a fairly good-sized book. I don't anticipate pricing it out of the market, so most people will be able to afford it. And I think there's going to be a ton of great information. And if anybody's ever looked at my Substack pieces, that I call it Thoughts from Enjoy the Ride, the style that I use with that is very friendly. It's just Tom talking to you, basically. I don't use very multiple syllable words too often, and I try to keep it real simple so everybody can understand. And the style of the book's going to be identical. So it's going to be me talking to you about my trading life and what I learned from it and all the different tricks I use to do what I do today. So
awesome. Well, it sounds really good, and I'll definitely be looking out for it myself. Maybe if it's out by Christmas time, I'll ask my fiance to buy it for me.
There you go.
That's awesome.
You and everybody else out there.
Yeah, everybody watching, definitely recommend. I like I said, I've been a fan for years, so this was an absolute honor. Before we close, where can people find you? You have your website, enjoytheride.org. Any other place?
Twitter is at Basso _Tom. There's about 8 imposters out there, so be careful.
Okay.
I've tried to ban every one of them, but who knows what Twitter's doing? Their security sucks, I think.
Yes.
I'm on Facebook, enjoytheride.world. I think it's at enjoytheride.world. I'm also, you can search for my name. I'm on, Getter, Truth Social, LinkedIn, MeWe, and Parler.
All right. Well, there you go. Everybody make sure to follow.
Then I also have the website is enjoytheride.world, which you have on the screen here behind my name. That's the website, and that's where I update my hedge signals and my explanation of why and how I hedge. And there's a whole lot of other resources there that I've collected over the years, and I tried to just pull them all together. And we get thousands of visitors, traders visit that site a month. So it's a very popular site. And basically the stuff in the store, like $10 position sizing book, I don't make a lot of money on that, but it ends up paying for the website. So I'm just trying to not go into my own pocket to run the website, which is, I figure, is a resource for traders. So as long as it remains profitable, I'll just keep running it. It's not a lot of work on my part, and I just add a few things to it every now and again when it amuses me. And it's all good.
That's amazing. Well, Tom, thank you very much for coming on. It's been a pleasure, and I look forward to maybe speaking with you again in the future.
Thanks, Nick.
All right. Catch you later. Bye-bye.